I think there's this misnomer with advisors that, it's about getting a slightly better performance than the bike down the road, or maybe it's about what you could do yourself. But my personal experience with advice, and I love my advisor.
Welcome to another edition of Crypto for Advisors. I'm delighted today to have in the studio with me Jason Entwistle. Jason is from Hub24, which I'm sure all of you would know, and he's the Director of Strategic Developments. Now, Jason has got over 3 decades of experience in this space in Australia.
Revealing my age.
I've known you for most of that time, so revealing my age as well, right? But you have been a real pioneer in this space, and it's not a platitude, that I'm just throwing out there. You really have. You've been on this mission. I've known you for 25 years of building out technology solutions for advisors that just create simplified, automated, integrated workflows that can help make their practice more efficient and help them provide a better customer service. And right from the wrap platform days all the way through now to being one of the founders of Hub24, you've really driven a massive impact into the Australian ecosystem as a result of that. So it's thank you for coming onto the podcast and welcome to Melbourne as well.
My pleasure. Thank you, mate. It's good to see you.
Excellent. So, look, I was going through your results, Hub24 results. So I think you've been there for 12 years now, and you're just going from strength to strength. So the earnings last financial year, your earnings were up 38%. Your profit was up 44%. Your funds under advice was up 30%, and your active advisor numbers were up about 15%. So is that job done?
Not at all. Not at all. So Hub is enjoying a really healthy period of growth. Lots of advisors joining the platform and continuing to drive more clients to the platform, driving our flows and driving the financials you just referenced. So that's all fantastic. But ultimately, our purpose, which is to deliver solutions empowering advisors and accountants actually to deliver more advice to Australians. We're only just starting. We've got a huge supply gap in this country of lots of demand for advice, not many advisors left, 15,000 odd we talk about, to deliver that advice, which means only not far north of 10% of the population is actually getting full advice. Now, every survey says, both domestically and globally, that those who get advice have better outcomes, especially in retirement. So it's a really good thing that people get advice. And with so few getting it, that's a real challenge for us. If we could get more people getting advice, better retirement outcomes, less age pension reliance, less tax we have to pay to fund that, there's a whole lot of community good would come from people getting more advice. So that's our challenge. How do you grow it from 10%-ish today? What if 20% of the populace could get advice, afford it, really enjoy the experience? It would be a big deliverable outcome, a measurable outcome on our economy. And so we are driving for that. That's our sort of North Star. We keep pushing.
So it's a great mission, great vision, and one that you've been remarkably consistent on throughout your career as well personally. Is the pathway linear? Is it still, essentially doing more of what you're doing, just rolling it out and integrating better, or is there is there a new way, a different way that you need to meet that challenge?
Mate, you referred before to my age, or my experience, I should say. So literally, Hub is my third platform in 35 years, 36 years this year, and if I look back at the 1990 platform called Navigator, pre-Windows, DOS-based technology, sending floppy disks out in the mail. Like half your listeners wouldn't even understand what I'm talking about. Yep. But we actually solved some of the problem back then. And if I describe the problem, advisors having given advice to a client need to then, on acceptance, implement that advice. And platforms like Hub24 get involved in that implementation process. So we will take, the check from the client, invest it in one of our financial products, and then distribute it across the range of investments that the client and the advisor have agreed to do. And now getting that data back to the advisor so they can do a review, deliver reporting to the client. In 1990, we solved it. We called it closing the loop. We did it through floppy disks and things, but it was a much simpler era, much less investment options. But what we call closing the loop from advice through platform and back, we actually got it right. So we had one way of doing business and a single view of wealth. Roll forward 35 years, I feel like we're further away from that than we were back then. Now, the environment's much more complex. Listed assets, international domiciled assets, and the big topic of today, crypto assets. There's so much complexity now in the kind of the investment universe, if you like. And there's also lots more regulation where in the past you might have been able to adopt a single platform for your business and say, well, that's just how it work. The best interest duty means most advisors use multiple platforms. And what does that mean? Multiple ways of doing business. So we have lost productivity. Advisors see less clients now by a factor of 3 or 4 than they used to. So this has become a really big problem. Now, we think the solution, the new technology coming, is going to give us a whole range of new solutions that we just couldn't do 5 or 10 years ago. It's humming so quickly that even a year ago we couldn't do it, and we can do things now. So, there's so much media around it at the moment about new AI kit coming. No one's sure of the impact of it, who's going to be the winners and losers, but we're really excited about it. And ultimately, we think it has the potential to mean many more Australians get advice. And not only those that will see an advisor, many will get it from digital sources as well. And that's done well. That's also a good thing.
Yeah. And you're right, there's a lot of parallels with crypto, which we will get into. But when you think about that challenge, are the main barriers, are they investment into technology? I know you've been quite vocal about that, and that Australia relative to, say, the US or other jurisdictions is underinvested by an order of magnitude in technology. Is it regulatory? Is it client driven, or is it just a lack of advisor numbers and not being able to meet that client demand? I mean, how do you weight those barriers?
Without picking on them, the regulators, I do start with regulation. The way advice is delivered in this country is in a really narrow form, defined in the legislation as financial product advice. And even the fact that the word product is in there, I have a problem with. Not all advice needs to be product related. So it just shows the genesis of our industry, where it came from, which is commission sales of products, tied agency, sort of old insurance sort of selling background. And that was a lot of financial advisor in the very early days came out of, that heritage. And so product selling was the sort of main thing they did, a distribution force. We called them distributors, and over the journey, advisors have upskilled, broadened the services they provide into really strategic advice. And I think there's this misnomer with advisors that, it's about getting a slightly better performance than the bike down the road, or maybe it's about what you could do yourself. But my personal experience with advice, and I love my advisor, my team of advisors, I should say. Hello, Warwick. For me, they keep me accountable, making sure that I do the things that we've agreed, and that might be stick to a budget. It might be signing certain documents, which I can get really lazy at. So, but it's keeping me accountable. So my financial well-being just ticks along. And it's managing my fear and greed, nuance, instincts, which I don't care how long you've been in the industry, you're still subject to. And so, every 5 or 10 years, an event happens where you can't help but go, oh my goodness, do I need to react and have that nice, calming, soothing call with the advisor saying, hey, we planned for this. We talked about this. Just put the phone down. We'll have a chat in a couple of weeks. And that managing your fear, managing risk, and keeping you accountable is as much the real value of advice as it is which investments you're going to invest in. So, so the sad thing is regulatory settings are a very narrow form of advice, and it's largely about product. And the regulations haven't grown into different shades of advice. I might not want to do, sorry, I'm hitting the thing. I might not want to do an ongoing fee service. I might want an episodic advice or just advice on a single thing. And those things are actually difficult to do in this country. Overseas, there's markets that stuff is really easy.
Yep.
So I think we've created an environment where we've got a limited supply of advisors, which is, also due to regulatory settings, a limited type of advice that they can give. And that has really disrupted the supply of advice.
Mm-hmm, mm-hmm.
So moving forward, we've also got really high barriers, big compliance needs. So on average, advisors see 100 clients.
Mm-hmm.
And that's a really consistent number across the industry. We see it all the time. Some break outside of that, but there are others who do far less as well. So the average of 100 has stuck with us for years now. It used to be much higher, but it has absolutely come down.
Again, because of regulatory requirements, right? You can't be seen to be providing a cookie cutter approach. You have to, demonstrate that it's personalized if you're providing personal advice.
Now, I'm going to get into a controversial area. And
Excellent.
so related to this is we have trained our advice industry to not pay much for technology. So if we look back at the structure of the industry, 10, 20 years ago, the big institutions dominated the space.
Yep.
It got to a point, I think, where a couple of insurers and 4 banks probably were sitting on licensing, servicing almost 80% of advisors in the industry. Now, this is pre the Banking Royal Commission, which unwound that.
Mm-hmm.
Now, in that environment, that again, it was those institutions who were very keen on that being a distribution force for their product.
Mm-hmm.
And as part of the benefit of being inside those networks, you got your software for free. You got licensee services for not much.
Yeah.
And so we trained an industry not to invest much in tech.
Yep.
And the result of that is we don't have really strong advice tech companies. Platforms like ours, that part of the value chain, we've spent billions in technology and we've got an economic model that can support that kind of investment.
Yep.
I think the platform industry, some numbers that NMG produced a few years ago said it's about $10 billion in revenue as a pool. The financial advice software business, Explain's the leader. And if you look at their numbers, I think they do about 130 million, 140 million a year, and they're 70% of the market. So let's say that's a $200 million pool. That's a tiny pool compared to our part of that value chain, right? So there's not much money going around in that part of the system to really help with great technology inside the practice that will change this productivity equation. Now, that is also a bit of a flow-on effect of the regulation. Regulation created an environment where the big institutions sat all over the advisors, big Royal Commission, they unwound it all. We ended up with this fragmented market. So all of this history has landed us in this spot where I think the advice profession itself is thriving. Lots of people want advice. So demand's really strong. Their practices are profitable, but they can't see as many clients as maybe they want to. The technology's not there for them to really ramp up productivity. And here we find ourselves with a big supply gap.
Yeah, look, there's a lot of paths we could go down on that one. I'm going to resist the temptation of going down the AI path because that's a whole rabbit hole, but a really important, dynamic and wave of change that is going to impact on a lot of what you've said. Instead, I'm going to try and tie it back into crypto because this is crypto for advisors after all, and we haven't spoken about it yet. So the interesting thing about the regulatory constraints is that when you look into digital assets, what that has meant is that Australian consumers just go offshore, and a lot of the innovation in digital assets have then gone and chosen to domicile in jurisdictions that are a lot friendlier, a lot more open and encouraging and welcoming, supportive. So there has been a brain drain as well. I think a lot of people don't realize that there's 2 new AFSLs coming out for the cryptocurrency industry in the middle of this year. And so the regulatory change will happen and it will be brought within the perimeter of advice a lot more easily so that established practices can start having conversations about crypto in a compliant way, which is exciting. Not many advisors yet understand what that means or understand enough to feel comfortable having that conversation with their clients. But you spoke about more clients wanting advice than are getting advice. And we know that 21% of Australians already have crypto, hold crypto. About a third of that are advised clients.
Hmm.
The vast majority of cryptocurrency holders or investors are self-directed investors. And I'm a true believer in advice like you. I come from that background, and for all the reasons you said, I absolutely agree with the power of advice. We know that 27% of crypto investors want advice. So there is this gap. How do we bridge that gap? Is that a client problem? Is that an advisor problem? Is that a practice problem? Is it a technology problem? Is it a regulatory problem? How do we bridge that gap?
Yeah, it's a really interesting one. So, we as a platform, we reflect the demand for investment solutions, because if we're getting strong demand for global domiciled assets, listed securities, American shares, we will add it because we want to cover, but basically all the investments the advisor wants to recommend to a client. With crypto, we haven't had a lot of demand, and we have added the stock standard ETFs that are on the market. I think there's a couple of managed funds that we've got that are dealing in crypto assets. And of our 120 odd billion dollars on the platform, it's literally single digit millions we're holding in those assets. So there's not a big push from advisors to enter that space. If there was, we'd probably add more. Now, we take our role as a gatekeeper, and this has become very topical with some scandals in our industry at the moment. Yep. But the platform is a gatekeeper where we need to assess investments coming onto the platform to make sure they're appropriate. And we take that really seriously. We've done that with these assets. They've passed our test. So it's not that they can't be used, but we have to look at the rest of the ecosystem to find out why, I think. So if we go up the chain, the advisor needs to work within usually an approved list set by their licensee and with the help of researchers, investment research companies. And my suspicion is, I haven't really delved in deeply into this, but I haven't seen much in the approved list that would suggest that, most of the licensees are saying, yep, go for your life, you can invest in these products. I think they're steering clear. Now, why is that? I'm postulating here. I haven't asked the question of the big licensees, but if we look at the scandals at the moment, where a couple of funds got through the gate, when they shouldn't have, and $1 billion was lost in the superannuation system, as it should, the system really bucks up and says, hang on, this can't happen. We've got to figure out why. In that environment, there's definitely a reversion to vanilla is good. Let's just amp the risk down. Go for the more stock standard products, I believe, and so they're probably steering clear because it just feels an environment where you put your head above the parapet, you might get shot. Yeah. So I suspect that's what's going on. The challenge is the technology itself that underpinning crypto is in all sorts of environments in jurisdictions is being tested to take complexity, friction out of the system and make it much more efficient. So our own RBA and our own banks are testing it at the moment. We had BlackRock in our office the other day talking about the assets that are being tokenized and that they're a big supporter of that, and they're really trying to push that barrow, but they're a bit scratching their head as to why the take-up's been so low in themselves. But it does feel like there'll be a tipping point where stablecoins come out with backed by underlying intrinsic value and become the norm and take a lot of friction and fees and complexity out of the system. Great. So if that happens, we're going to have to get comfortable with this is just part of the landscape.
So I'll come back touch on the utility component of the technology in a moment, because I agree. I think that crypto as an industry is evolving from its speculative youth. It's going through its awkward teenage years, and what's going to emerge is its identity as an adult, which is the utility, and that is still emerging. So we'll come to that in just a moment. I just want to rewind back to where you started, which is talking about the demand that's coming through for crypto on the platform, and that it's negligible at the moment. I probably see it a bit differently, and I'd say that you're measuring demand based on advisor demand, not on consumer demand.
Oh, yeah, definitely.
And from an advisor point of view, we know that 89% of advisors have never advised on crypto, have never spoken to their clients about crypto, 89%. Interestingly, exactly the same number, 89% of retail clients want to speak to their advisor about crypto, right? And so again, that's that disconnect, right? And we know why. It's there's the guardrails haven't been built for this to be sitting on the shelf as an asset class next to Australian equities, international equities, emerging markets, managed funds, ETFs. And so it can't be. You can't discuss it in a compliant, advised conversation because it's not on the APL. It's not subject to PI insurance because the research houses aren't providing research on it. The asset consultants don't have a 70-year longitudinal data set to analyze and say this is a role it should play in a portfolio. And so all of those guardrails that apply normally to an asset class in the industry that allows it to be safely embedded don't exist. But the consumers are already doing it. And they're doing it outside of that advice relationship, which weakens that advice relationship. They're going and they're jumping onto Google and they're saying, how do I buy crypto? And good luck. I mean, hopefully you come across a reputable platform like SwiftX. Shameless plug, Ting. But there's a lot of people out there, who are influencers and shilling their own products for their own purposes, and that's a dangerous pathway. And the advisor, I would argue, controversially, is being negligent in their duty to protect their client by allowing that to happen. And so we need to step in and we need to build those guardrails, and I'm not here to sell crypto or say that all these clients should have it. That's up to the advisor and the relationship with the client and the client's financial goals and their risk appetite and their time horizon, all of those things. But it should be there on the shelf so that if it is the right part of a portfolio or diversified portfolio, that the advisor can help them with that rather than forcing them down the self-directed pathway.
Do you know, is that amazing stats? Do you think, is it the client sort of wanting to keep it on the side and not talk to their advisor about it? Maybe, they're more on the speculative end. It's a dirty little secret.
Don't tell them about my sports bet account.
Exactly.
Yeah.
So, just on that one, we have technology now where we can suck the data out of a client's bank account, which is amazing, right? We could do automatic fact finds, like a reverse fact find.
Yep.
We can.
It's great for credit scoring for you, not so great for the customer sometimes.
Yeah. So, but the challenge we have with the client in saying hand over that data is they may not really want you to know what they spent on the weekend.
Yeah.
And maybe that's a bit like the sports bet account or even this crypto issue.
Yeah.
Are they sort of actively keeping it a secret? And the advisor's actively saying, no, don't talk to me about that. It's I don't know where that sits.
Look, I've never really picked up on that as a sentiment in the industry. I think that in the early formative days of crypto, Bitcoin, it was absolutely originally conceived by, the cypherpunks, the combination of technology geeks doing cryptography and libertarians who are trying to, keep all of their money and their wealth away from governments and institutions, right? So absolutely, it's got that past in it, but I don't get that sense. And if you think of it and just apply the pub test, you think. For me, every time I go out to, and this is why I got into crypto about 5 years ago, because I got sick of having the same conversation. And it was with all the dads at my kids' schools, friends that you meet at barbecues. And as soon as crypto comes up, they'd all say the same thing, which is, I'm really interested in it. I'm not sure if it's right for me or not, but I want to look into it and I'd like to work it out. But my advisor won't talk to me. My accountant won't talk to me. They'll talk me out of it, try and talk me out of it, or they'll say, I just can't discuss it. And I don't have time to go and figure it out myself. And I thought, wow, that's a real failure of the advice industry to be able to help them meet that need. And it's a real risk to the consumer of doing it themselves and exposing themselves to fraud, potentially bad actors. But there's also the risk of them not doing anything. And Bitcoin, why is there all this demand? Bitcoin's been the highest performing asset class 9 out of the last 14 years. Now, yeah, the years it hasn't, it's been down a lot, and it's down a lot at the moment. But volatility is a feature, not a bug, when it comes to crypto, right? And that's why people want some exposure to it. So I think, that piece around, is it them sort of a dirty secret and a sports bet account? I think probably at a younger age, there's a more of a nihilistic kind of attitude, and they're like, oh, what the hell? I can't get into the property market. I can't, Australian shares are, giving single digit growth really isn't exciting me. I'm going to throw a bunch of, I'm going to throw a few $100 into crypto and have a crack. Absolutely, in the younger cohort, it's more akin to a sports bet account. But in the older people that I talk to, no, it's more, they want to use it responsibly. They just want to have some exposure, but they don't know how to go about it, and no one's helping them.
I find it hard to say the advisors are being negligent. I don't think the system's really supporting them to do it. It's if the research isn't there, the licensee hasn't got on the approved list, like there's really nothing they can do to to go outside that boundary, and they're going to get hit.
Sorry, I should rephrase that. It's not that the advisor is being professional and prudent and having a fiduciary duty and doing everything that they should be doing. That's not what I mean that the industry is being negligent in not solving that problem and allowing the advisor to have the conversation. But yes, good pick up. Thank you for bringing me back in line.
Oh, good. Your advisors are my friends, mate.
Yeah, I know. Mine too. Sorry. Let's go back to utility. That's where you were leading this conversation. And so, I mentioned earlier that the way I describe crypto at the moment is we're going through the messy adolescence, where you're trying to find identity, but you're shedding off your youth, the exuberance of your youth. And when we look at what that future identity is likely to be for crypto, and this is where a lot of people misunderstand it. They think it's just purely speculative and there's no underlying value. And it's like, well, no, the technology is the underlying value. And the technology is starting to evolve to a point where it's replacing legacy systems across a range of industries. So the first mass use case for that is stablecoins. So stablecoins, for those who don't know, a type of digital cryptocurrency, which is pegged to something, and 98% are pegged to the US dollar. So it's basically just a digital representation of the US dollar. And they've found a mass use case in global payments, because if you're sending money from one side of the world to the other, if anyone's done that, they know it's an extremely painful process and very expensive, with lots of people taking a chunk on the way through that. And the more you're sending, the more you're paying for that. And it takes time, right? Whereas with stablecoins, you can do it instantly for very, very little. And it's just a much simpler, better solution. And we're seeing that transition. And in the US, the Trump administration brought out the Genius Act mid last year, which has laid down a clear regulatory framework for stablecoins to exist within the financial ecosystem, where things like you've got to have one-to-one custody for US dollar or gold, which was a bit of a masterstroke in my view, because stablecoins are now the 7th largest buyer of US treasuries globally, from nothing to the 7th largest buyer, exactly when Trump is trying to get the 10-year yield down for obvious reasons. So I think that has transitioned. So stablecoins are there and have taken over. You mentioned digitalization or tokenization, and real world assets. And that is now forecast to be the next big one, that in 2026 we'll start seeing a similar exponential growth as we saw with stablecoins last year. That tokenization of assets, or that migration onto the blockchain, how significant is that likely to impact on your business and the way that you might custody or even, service your clients? Because my theory on it is the end consumer doesn't care if it's on blockchain or not. They're probably never going to know. And if we're doing our jobs, they won't know. They just see it happening a lot quicker and it's a lot cheaper. So how do you see that migration affecting your business?
Look, not quickly, and it's probably going to be even hidden from us in some ways. So we have 420 odd billion in custody, but we rely on underlying custodians, normally global banks, to do the actual custody process for us. So we sub-custody out. And so they'll be probably the ones much more affected by the infrastructure of all sorts of assets changing. And it's sort of hidden from us a bit. And so on the platform, we reflect what the custodian's records. And 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 in doing that, if they happen to be using blockchain technology or distributed ledger to be using that for payments or using that to hold certain assets or tokens, then they might be doing that, but it might be hidden from us. So we'll just reflect on whatever their records say. I think looking further out, mostly new types of assets come onto platforms like ours, wrapped up in either a listed vehicle like an ETF or a unlisted vehicle like a managed fund. And that's exactly what's happened so far. So we've got crypto assets sitting in ETFs and managed funds, and currently not being used, but we'll see how that changes. I think it'll be some time. I think that will be the path for the foreseeable future, that as it really grows, there'll be more fund managers come in, more ETF providers offering those kind of services. It'll flood our list with new options. That I think that'll be the immediate kind of, in the short term, that's how it will play out.
Yep.
But if you look beyond that, in the same way that we went as an industry, platforms, we went from just having managed products like managed funds, and then we had direct shares. We only had fixed interest funds. Now we have bonds. So at a certain scale point, and if there's certain demand, we unbundle those collective investment schemes and offer the underlying real assets. And I think that's the same probably will happen down the track, where, it's all held in managed funds for a while, but the reality is there's intermediaries in place when we do that. And it might be worth everyone in everyone's interest for us to offer the direct securities or the direct tokens at some point.
It's a fascinating component of this evolution or maturing of this asset class is this institutionalization. The purists are, screaming, from the rooftops about it, because it goes against the very foundation principles of Bitcoin, of crypto, is sovereignty of your own wealth, and being able to hold it in a decentralized way where you're not relying on a centralized institution or government, but you actually have sovereignty over it and custody over it yourself. And that still exists and is a core part of the proposition. But it is interesting that as we evolve and we move from the self-directed market into that advised client market, that is much less of an issue. And it's really more about price appreciation and finding companies that are creating value and as an investment and trying to get some exposure to it. So I think you're absolutely right. And we've seen that in the US in 2024 when the ETFs opened up in the US and we saw the BlackRock IBIT ETF for Bitcoin. It was the highest growing ETF in history. It doubled their gold ETF in 7 months. That's a 20-year gold ETF, and it doubled it in 7 months. At its peak, it nudged nearly $100 billion of funds under management. The chart is literally vertical for it. And that's tapping into that latent demand. And I think that latent demand exists in Australia. Where when we have the regulatory environment and the right products, that you will see a similar uptake. Obviously, we're a much smaller market than the US, but you'll see a similar style of uptake where people will tap into that through the structure they're used to. And that's where it's good. It's like, this is an exchange traded. It sits within the rails that we've already got. Our compliance team understand. We know how to talk about it. It's an ETF. It's familiar. It's just exposure to a different type of asset. But there are some fundamental disadvantages of it. One that I've touched on, you don't actually own the underlying asset, which is the whole essence of the proposition. So you own units in a trust that owns that asset. The second is it's trading in market hours, whereas crypto's 24/7. It doesn't sleep. It's trading constantly. So when Trump won the election, it went up 18% in that weekend, and you're locked out for that. Or last weekend, it went down about 10%. You're locked out of that as well. So you're going to miss some of that volatility in that situation. And third, it introduces a counterparty risk as well. And I know we say BlackRock, but look. 2 years ago, we wouldn't have thought that we're questioning the US as a strategic ally either. So who knows, what's going to happen down that path. So I agree. I think that ETFs will be that Trojan horse, if you like. But I think that also we'll see pretty rapidly people wanting to move into spot and actually get more targeted access to particular protocols and businesses, and actually start, as they learn more about it, start saying, actually, I want to actually own the underlying asset here.
And that's the same dynamic we've seen. In the 90s, we pushed from managed funds into direct underlying listed securities.
Yeah.
And I think every decade we've sort of opened up the platform where we've unbundled some of the collective investment schemes and given access to those underlying direct assets. Now, we'll never have an airport in the platform. Those kind of things need to be fractionalized through collective investment schemes. But the tokens obviously make a lot of sense. You can hold them directly. The infrastructure's got to be in place though, and that's going to take all parts of the value chain, the custodians and groups like us and so on, to all line up and be able to do this at scale and deliver the service that's going to be expected, which is, I can trade on a Sunday night or whatever. So people hate it when platforms like us get involved and take away some of their flexibility and what they can do outside the platform. So, it's a challenge for us.
Yeah, it's a challenge that's going to go across all the asset classes as well, I think. I mean, if you in the US, they're talking about all the exchanges migrating within 3 years onto the blockchain.
Yeah.
I mean, that is that's crazy when you think about that. And especially in the context of Australia, when we look at the ASX and their first attempt at that and how that went and where they are at the moment as well. I don't think it's going to be happening in 3 years here. So yeah, but it does show that this technology is being implemented and rolling out pretty rapidly. So there's utility there. Some other things I guess we'll probably just talk about, because a lot of the viewers don't understand where this utility is coming from. We've spoken about stablecoins, spoken about blockchain technology or tokenization on the blockchain of assets. Some of the other things we spoke earlier touched on AI, and there's a lot of commentary around that crypto is the native currency for AI. There's a lot of reasons why that could be the case. These are very much in its infancy as far as what's that relationship, but when you start seeing Claude Bot, for example, people buying Mac Minis and setting up their own Claude Bot instance where they can operate as their own PA and have autonomy to actually transact. I'd be much more comfortable using crypto rails where you can actually embed smart contracts or rules within the currency so that they can't actually go crazy and start, spending out beyond what the parameters that you want. So there's some things like that I think crypto can bring to the table. Have you got any thoughts on AI and the relationship there?
Probably haven't thought too much about the relationship between AI and crypto, and I understand exactly what you're saying there. The fact that in that crypto environment you can set contract rules effectively around it, give it guardrails, makes a heap of sense. At Hub, we've done a lot of research in fact, we've got an innovation lab. It's been running about, I think this is year number 8. And one of the first things they looked at was the application of blockchain to our platform. Was the future of our platform going to be to move to a distributed ledger kind of environment? We did that in parallel with effectively the ASX's first attempt, and I'm happy to say that our innovation lab said that's probably not the path for us. So we haven't gone there, but at around the same time we started tinkering with AI technology coming through as OpenAI version 1 and all that forerunner technology. And so we've got a deep history at looking at the tech that as it's being developed, testing it out, trying to find an application for it in our business. The last 2 or 3 years, that whole landscape has massively changed, and the speed of change. Even I was at dinner last night with some tech bros, and they were talking about just the upgrades coming through over Christmas have just taken leaps and bounds from what you could do just in November to today. It's
incredible.
It's moving really quickly. So we are trying to grab hold of that steam train and go with it. It's I think one thing we've underappreciated with that technology is the change management required for such big changes in such a short time is sort of, I think we're at the limits of, generally how big companies and institutions have traditionally sort of reacted to change. They're just being forced to change so much more quickly. So, which is a good thing. It's a big challenge for everyone. But the benefits of this tech are, they're going to be amazing. I think I'm really positive for the advice community that today what can take hours, if not days of work, we should be able to get down to minutes. And if we can do that, maybe they can see twice as many clients
Mm.
every week. And that would be a huge, coming back to my first point, that would be a huge win for our industry. So we can literally see in our innovation lab how that's possible.
Mm.
So I think there's no doubt that will play out over the next 2 or 3 years, that tech will come through and come through relatively quickly, which we're super excited about. And we'd love to play a big role in that, but we won't be the only one. There'll be lots of groups having a crack.
When you're describing your own advisors and or team of advisors and the role that they play for you personally, the thing that was bouncing around in my brain about that was, I kind of use AI for that.
Yeah, right.
And I think that a lot of that, there's going to be a very interesting evolution in this space where a lot of that will be able to be done by AI. And so what role will the human play? And I truly believe that there's absolutely a critical role for a human in this advised relationship. But I do feel that there is going to be some disruptive, fast change in the nature of what AI does in that value chain or in that value interaction, and what a human does. I think that's going to happen very rapidly, and it's going to be very disruptive because it comes back to you saying about the challenges of a large institution in managing a speed of change like this. Its core, the advice industry has a fiduciary duty, which means it is, first of all, interested in the risks. And how do we manage the risks? What are the risks? How do we manage? How do we mitigate? And then it can look at the upside and what's the return and the benefit. But trying to even govern AI, for example, it's moving so rapidly. I mean, you can't keep up with it. And how do you build systems when you've identified those risks? They're redundant before you've built them. And so if you can't even keep up on the risk side, how do you build something and get it out there in the market to help customers on the return side?
Yeah, look, it's definitely a challenge. I can tell you that even in our innovation lab, by the time we've assessed something, played with it enough to decide that this is actually something that's got real application in our business, there's probably another version coming in already that, we might as well wait and use the next one, but that just keeps happening.
Yeah.
So we're having to deal with that. And the pushing innovation lab projects out into production is a big challenge.
Yeah.
It's a really different environment. When you're dealing with $100+ billion platform, we can't just throw any code at it. We've got to be really careful. So we just have to do the best we can. And while AI technology, the main use in our platform environment will be helping us code faster, etc. But that doesn't mean we don't test it. All the risks are assessed and everything else, because nothing can go live until it's absolutely been tested.
100%.
Back to your point about, would you use an advisor or go for an AI engine? We think about this a lot. We are an intermediated only business.
Yep.
We work and empower accountants and advisors. So if they're going to be disrupted by AI tech, then we'll have to think about a different market. I'm really confident that while it's not for everyone, there's a segment of the community who really want to feel that peace of mind and would prefer to deal with a human. And I know I could sit down at night and chat away with ChatGPT or something else and ask it all sorts of questions and get some answers. But you know what? I'm busy and I'm really happy that someone else does that for me. And I don't have to question whether they're hallucinating or not. They know their stuff. And so for me personally, that's my situation. I want peace of mind. I really enjoy the relationship. I know they've got my back and I can rely on them.
And they're executing.
They execute. They do it all. And, I'm probably using them more for things that I just hadn't thought about using them for. And they said to me, Chase, can we look after that for you? Oh, man, that would be fantastic. So I'm really enjoying that experience.
Yep.
My view is there'll be a large part of the population who currently not getting advice and will receive it from digital sources. And that's actually a good thing. But there is going to be a percentage of the population that says, I can afford it. I don't want to do it myself, and I'd really just want that peace of mind. I want a human in the loop. If you're delivering advice under our current regulatory settings, there really needs to be a human in the loop at the moment. We can't trust enough this technology to get it wrong, and you can see when things can go wrong systemically what happens here. So So our view is this technology should be applied to change the mechanics of producing advice.
Mm-hmm.
So all that manual work that took hours, we can make minutes. But apply those same resources to the front end to service more clients and deliver more value.
Mm-hmm.
So I'm really interested in seeing what's happening even with the banks at the moment. And then banks are investing really hard in this space. You might have seen last year before Christmas, Westpac, one of those classic announcements in the paper, getting rid of 200 tellers or whatever it was. But in the same announcement, it said, but we're introducing a new role in the branch called branch concierge.
Mm-hmm.
So as we automate and improve our process and we can remove some of the back office staff, we're introducing front office staff to give the clients a better experience. And I think that's exactly the opportunity for the advice industry. So take out that back office manual work, but do more for the clients. And Hub, we have done exactly this. We have about the same administrators today or operations people as we did a couple of years ago. Now that's amazing. We've almost doubled in size since then. But not only that, we've been able to take a lot of back office roles out and put them at the front. Now, what's happened in the meantime, our NPS score's gone from the 30s to the 50s, and it's a direct relationship to us being more proactive, servicing, more hand-holding, more client-facing stuff. And I think that's a really big opportunity for the advice industry.
NPS in the 50s is amazing, by the way, so well done. But
Thank you.
ironically, it's leveraging technology and AI to be more human. Which is fantastic. All right. Now I'm conscious of time, so I want to flip the table a little bit and for the last question. So my role at SwiftX is trying to bridge that crypto service gap and trying to build those guardrails to connect digital assets into the advice ecosystem. And we've touched on a fair bit of that. If you were me,
oh, here we go.
what would be your priorities in doing that?
Make it much
well, the goal would be
ecosystem.
No, the goal would be that an advisor has simply got digital assets on the shelf, on their products, on the shelf that they can use for their clients as they would any other asset type. Getting it on the shelf.
It's relatively simple, but not easy to achieve. So, my advice, and we get a lot of approaches for technology, investment solutions, whatever, to become part of the advice industry, and aligning with the ecosystem that we live within is the golden ticket, right? So, but there's so many parties. And so I don't know where to start, but probably at the top, licensees and researchers. You mentioned before about the volatility, that freaks advisors out. When clients want peace of mind, and it's one of the number. I think every survey shows why you're using advisor, peace of mind always comes up number one every time. So, but fretting about the volatility of my investments, I think that's where advisors would rather. You don't need that. You can have a simpler life. You can be a bit more. So, I think as the stable coins come through, backed by real assets, dollars, gold, they'll end up with bonds. So many more assets sitting in there. I think it becomes an obvious thing that we're going to be using this as part of our industry infrastructure, but it has to come into the fold and be part of our ecosystem. So that is custodians, it is licensees, it's researchers, all the things that advise, and is everything put together so they can go, yes, I can recommend that. And so the advisor themselves is sort of the last part of that chain. And it's all the infrastructure around them that has to be, make sure the regulations work, the insurance is in place, the approvals are there, everyone's feeling good about it. All the groups like us, technology is all available. All of those pieces of the puzzle have to be put in place. So I don't know. I can't tell you where to start though at the moment.
Oh, that's right. You're validating the approach I'm taking. In essence, you've touched on two of the three things that I'm doing. Because the third one for me is that building those guardrails. And like you said, you start at the top. You talk to the research houses and doing that, the custodians, the asset consultants, the licensees, and you build those guardrails so that it can be consumed in the way that the industry needs to consume it. the middle one for me is around transparency, and that's getting it into platforms like Hub24 so that you can see it, and so that the client can have a holistic, the advisor can have a holistic view of their client's portfolio, including any holdings they might have in digital assets. So that visibility, if you can't measure it, you can't manage it, and you need to be able to see that. So that's the second bit. But the main one that I spend the majority of my time, and indeed why I do this podcast, is education. And because the vast majority of people within the wealth industry just don't understand where it's evolved to, especially just over the last 2 years. And so that's why it's really important to get this message out. So I thank you for helping me on that journey and coming in and giving me up your time and letting me tap into that brain of yours. Hopefully we will continue to work on integrations and get digital assets into Hub24. As we can prioritize it in our relative tech stacks, and I look forward to many more conversations about how to do that with you.
Mate, thank you very much.
All right, thank you.